Hello there. Welcome again to Financial Accounting Info. Uh, Today we want to look at the question again, still on November 2022. This is question 5, and it's a question on statement of comprehensive income, and also it also requires us to prepare notes to the statement of financial position and also draft the statement of changes in equity for the year ended 30 June 2021. Right. The question reads: You are provided with the pre-adjustment trial balance of pre-data traders on 30 June 2021. Then on the required part, the first part, the question is saying prepare the statement of profit or loss and other comprehensive income for the year ended 30 June 2021. That is the first part. Then the second part, it requires us to complete only the notes to the statement of the financial position. And also, lastly, we also have to draft the statement of changes in equity for the year ended 30 June 2021. Then we also have a note there which reads the statement of financial position is not required. Read that the traders use the periodic inventory system. This is in the valuation of inventory. Remember, valuation of inventory, we've got the periodic inventory system, and also we have got the perpetual inventory system. So we have got those two systems, right? Here, I think we can just take note of one or two terms that we have in the question. The notes to the statement of financial position, they are referring to the workings. We have got figures that we need in the financial position, and those figures will not be given, but we have to calculate them. For example, the inventory figure, we might have different types of inventory that will be there in the question. So we need to prepare a note. So in that note, we are just calculating the total inventory that we have. Remember, we might have inventory, for example, we might have stationery, we might have consumables, etc. Right? As those are some of the examples that we have for inventory. So you have to add them all and uh, uh, transfer the total to the statement of financial position. And also you've got trade and other payables that needs to be calculated also. Remember, trade and other payables consists of trade payables control figure that were given in the list of balances, and also accrued expenses are under that. And we know that, and also we have got prepayment of income also falls under trade and other payables. Then also we have trade and other receivables, where we have got the traders receivables control figure that we are given, and then we are supposed also to include accrued income, and we are also supposed to include the prepayment of an expense, right? Those are some of the workings that we need to pre-calculate before we prepare the statement of financial position. So that's the part that we are having here, that is 5.2. And also on the statement of changes in equity, we know equity refers to the owner's funds. We know that the owner contributes money to the functioning of the business. So whatever is being invested by the owner in the business becomes the equity, or we might call it capital. So the changes in the level of that capital or equity is the one that is being asked to draft the statement of changes in equity. So that's what we have. So we can go and try to look at what we have in the question so that we can be able to answer that question. Right. If you move to the question, we are given the balances there: pre-adjustment trial balance of pre-data traders on 30 June 2021. And then we are given these balances on the debit side and the credit side. And we've got these balances that we are given. We can go down to check the other information that we are given there. And then we've got the nominal section. The nominal section represents the actual amount that was received or paid. If it's revenue, we are saying this is the actual revenue that was received in that period. If there is any adjustment that needs to be done, we see them in the additional information. That's when now we are going to adjust. Maybe if you are, for example, for income and expenses, we adjust for accruals and prepayments that will be mentioned in the additional information, and any other adjustments that might be necessary to be adjusted, we see them under the adjustment and information section or the additional information. So this is the information that we have. And then we go on to adjustment and additional information. This is the information we have. This is inventory on hand on 30 June 2021. So this one is representing the closing balance of inventory. Remember, the opening balance of inventory are given in the list of balances. And remember, this statement of comprehensive income that we want to prepare is for a sole trader. Remember, I've got three types of business. That is, we have got a sole trader, we might have a partnership, and also we have a company. Those are different types of business that we have. But in this case, we are going to prepare for a sole trader. That is one person is operating a business. So we go to the next page to see other information that we are given. Right, we are also given this information from information 2 down to the last one. So these adjustments, it's very important to go through these adjustments before we start to answer the questions, because they will help you as you go down the statement of comprehensive income. You would know where you need to adjust so that you don't omit any adjustment that needs to be done. So this is what we have in terms of additional information. So in terms of any reference that you are going to make, we'll be referring to this additional information, right? So we go back to the question. The question requires us to prepare a statement of comprehensive income. So when we are preparing the statement of comprehensive income, we start with the figure 4. We start with the figure for revenue. So this is the figure that we can look for first there. If you go to the list of balances that you are given there, you will see that the figure for revenue, we are having it here under the nominal account section. Revenue, we are having 349,900. So that's the figure that we are going to put for revenue. But before you put the figure for revenue, also check if you have got some sales returns that are there in the list of balances. Because if there are sales returns, they are going to reduce the value of revenue or sales that we have. Also, you might also want to see if there are any adjustments that are there that are also affecting the figure for revenue. So you would need to go through the additional information that you are given to check whether we have got any adjustment that we have. Remember, on information 1, we have got the issue of inventory, which is not going to affect the sales figure. Then we go to 2, you check if we have any adjustment. You go through every adjustment that is given there, and you would see that we don't have any adjustment there that is affecting the figure for revenue. So in that instance, if you don't have any, you have to put the figure that you are given in the list of balances as it is. So the figure that we are given there, if you go back again, you will see that the figure that we are given there is 349,900. So this is the figure that we are going to put for revenue as the opening item that we are going to put in that statement of comprehensive income. So we go back to the answer section now. We have this statement of comprehensive income with 2 columns. So the figure that we are going to start with there is the figure for revenue. So here it means we are going to have revenue. And we've seen that the figure there that we are given is 349,900. So that's what we have, and we don't have any adjustment in terms of sales returns. If there are sales returns, we're supposed to subtract them in brackets and remove them, then we put the net figure here. So from there, we go to less. We go to less cost of sales. And remember, this figure we're saying less means we're subtracting. So this figure for cost of sales, we are going to put it here. We're going to put it here just under the revenue figure here. But we need to calculate it under that heading of cost of sales. Because remember, to calculate cost of sales, we are going to use that formula of saying cost of sales, we add opening inventory, we add purchases. If there are any returns, we subtract from purchases. And any adjustment that is affecting purchases, we subtract. And then we are supposed to add carriage on purchases if they are there in the question, and also add import duties if they are there in the question, because these are expenses that we incur as we transport those goods to our business. And then finally, you have to subtract the closing inventory. Then you get the figure for cost of sales. So the figure that we're going to start with beneath here is opening inventory. So we go to the question to check the figure that we have for opening inventory. Obviously, in the list of balances, that's where we are going to have that figure. We go up. That's where we've got that figure for opening inventory. Right. If you come here, you have got this figure that you are given at 1 July 2020. That's where you are given the figure for opening. But remember, the figure for closing is given in the additional information. So you've got this one, 24,340. So this is the figure that we are going to put there as our opening inventory. So we are now putting it in the other column. So we have got 24,340. And then from there, we are supposed to add purchases. We add purchases. We can indicate add there so that it becomes easier for you. Add purchases. And then before you put that figure for purchases, you go and check if there are any returns in terms of purchases that we have again in the list of balances. Remember, those figures for purchases, we are keeping them in the nominal section. So we go down. If you come here now, you'll see that the figure for purchases that we are given is 178,450. That's the figure for purchases. And then we also have purchase returns, that is 8,200. Remember, these purchase returns are going to reduce the purchases that we made. Remember, when you're purchasing, we are buying the goods, and maybe we see the goods are to be defected, affected, so we need to return them. So when we return them now, these are the returns, then they are going to reduce the amount that we bought. So that's the issue that we have there. We might also have some discount received that will be received during the process of purchasing. These are indicated as 5,750. Or this amount also reduces the figure for purchases or the amount of purchases that we purchased. So it means that so also going to reduce the amount of purchases, the purchase figure. So with that again, you can also try to look in additional information if you have got anything that is affecting the purchases again. You go through everything to see if you have got any adjustment that is affecting again purchases. So you see that in our question, we don't have such a figure that is affecting purchases. So if it's with that scenario, you have to go back and check the figures that you are given in the list of balances. So basically, what we are going to do in the answer section, we're going to say 178,450, we subtract 8,200, and then you subtract 5,750 to get the net figure for purchases. So we go back to our answer section. So when we are here now, we are going to say in brackets, we show the working of the figure for purchase that you are given is 178,450. And then we are going to subtract the 8,200 for the purchases returns, and then we subtract that one for settlement discount. This is 5,750. So if you calculate that one, we are going to get 164,500. So that's what we have there. And then obviously, we're going to check in terms of carriages. Some questions we have that figure for carriages. Some questions won't have. So if there's no figure for carriages, just keep that that amount. You don't enter it. So here you see that we have got a figure for carriages, which is 9,200. We have got a figure for carriages that this one is carriage for sales. Remember, so we are not going to put this one under that. This one is carriage on sales. We need to input carriage on purchases. That's the figure that we need to put there in the trading account. So we look for the carriage on purchases. We go down to check if we have got any figure for carriages on purchases. Right, we see that we have got carriage on purchases here, which is 9,825. So it means we are going to input that figure. And also you check any transport costs of transporting those goods that we purchase to the business that are there listed there. You would see that we also have import duties. Whenever we see import duties, we are going to include them just under the purchases as an addition, because we understand as we transport these goods to our business, we might import those goods. So those goods are going to pass through the border, and we know there are some protectionist measures that are charged there in terms of tariffs. So we are going to include it as part of the transport costs. So you add them there. So you are going to say under the figure that we have for purchases, we are going to put 9,825, and then we also put the figure for import duty is 8,750. So that's what we are going to do there. We go back again to input those figures. Right. When we are here now, we say carriage on purchases. Carriage on purchases. Carriage on purchases. And remember, the figure that we have there is 9,825. And then we also have import duty. We also have import duty, which is 8,750. So that's what we have in terms of carriage and import. And when we have put those figures in terms of carriage on pages and import, it means now we have exhausted the figures that are supposed to be there. Then we now add the figures that we have there. So before we add them, we also have to make an adjustment for closing inventory. Remember, we've got closing inventory that we have in the additional information. So here we are supposed to subtract closing. That is less closing inventory. And we go and check the figure that we have for closing inventory in the question. If you go to additional information just below the table, we have that figure. Right. On adjustment number 1, we have got inventory. So here you see that there are 2 inventories that we have there. We've got inventory 24,150, and then we've got consumable stores. So these ones we don't include them in the trading account because in the trading account we are concerned about the goods that we are trading, or the goods that we are buying and selling. Remember, we are buying goods, then we sell them, then we make profit. So those are the goods that we want to include in the trading account. For goods that we are only trading, then consumable stores now, although it's part of our inventory, it's not part of the trading inventory that we are looking for. So we only include this. So consumable stores will come under the statement of financial position now as inventory. We'll add it to this one to get the total for inventory. So that's what we have. So we are going to just subtract 24,150. So we go back to the other section. Right. So there now we have got 24,150. So that's the figure that we have there. Right. Having this figure now, we now add and subtract the closing inventory. So here we can close so that we now want to calculate cost of sales. So the answer that we are going to get there, we put it up there to represent that it's cost of sales. So remember, under this, we are calculating cost of sales, and we are saying less cost of sales. It means we are going to subtract the net figure that we get there, we subtract. So we're going to say 24,340, we add 164,500, we add 9,825, and we add 8,750, then we subtract 24,150. So with that now, let's try to find out in terms of what are we supposed to get there. So you see that after the calculation, you are supposed to get 183,265. So it's coming here as cost of sales 183,265. And remember, we're saying less, so we're going to show it in what? In brackets. So there now we now calculate the figure for gross profit. Remember the formula for gross profit, we say gross profit is equals to revenue minus cost of sales. So this is what we have here. We're going to say revenue, figure for revenue, then we subtract figure for cost of sales. Then the figure for gross profit will come here. So when we say 349,900, then we subtract 183,265, you are supposed to get 166,635. So that's the figure that we are going to put here, 166,635. So that's what we have. And this figure, remember, we are saying it's gross profit. So we have to indicate that it's what? It's gross profit. So when we come here, let's try to push our page up. Right. When you come there, we are now just supposed to indicate that this is gross profit. So here we say gross profit. So remember, this figure can also be a negative figure. If you get a negative figure here, you're going to show it in brackets, show that it's a negative figure, show it in brackets. And we won't call it gross profit now, it's going to be gross loss. So the scenario of a gross profit is when we've got revenue greater than the figure for cost of sales. But when we have a gross loss, it means our revenue is less than the figure for cost of sales. So that's what we have. And then from there, obviously, we go to other income now. Remember, we've got other income that we might have in the business. We might have some premises that we are renting. So we are going to receive rent, and we call it rent income. We might also have some interest on fixed deposit. So that interest that you are receiving is going to be our interest received that we are going to put under other income. And also in terms of allowance of credit losses or allowance for doubtful debts, we include them again under other income. If it's a decrease, we include it, but if it's an increase, we are going to include it under operating expense. So we can go to our question and find out what income do we have. In some questions, we might not, we'll find out that maybe there might be some other income there. So you just have to skip that heading of other income. If you go straight away to less distribution, administrative, and other expenses. Right. If you go to the list of balances that we have, so the figures for other income, we find them in the nominal section. Here, nominal account section here. That's where you're going to find the figure for income. So you can go down to check if you have income, purchases, not purchase returns, not settlement discount. We've already adjusted these ones, and then we've got interest on fixed deposit. Interest on fixed deposit, and it's 14,500. So what it means is this is the interest that was received. This is the interest that was received. But remember, when we are preparing this statement of comprehensive income or these financial statements, we are abiding by the matching concept. We need to put the actual figure of interest that belongs to the period that we are. So this amount that we are given in the nominal section just represents the payments that we made, the actual payments that we made, and the actual receipts that we received, irregardless of the periods of the receipts or the payments. So for us to see if they really belong to this period, we go to additional information to see what adjustments are there in terms of, for example, here we're talking about interest on fixed deposit. We're going to see what are they saying in the additional information. If they are quiet, it means the figure that we are given in the nominal section is the actual figure that belongs to that period. We just take that figure as it is and put it in the segment of comprehensive income. But if there are adjustments, we need to adjust and abide by the matching concept. That is, we only consider the amount that belongs to that period. Then we go to the additional information. Here we can go to the next page to see if we have got anything about interest on fixed deposit. So if you come right on item 2, we have got something about fixed deposit there. They are saying African bank and IT problems during the year, African bank and IT problems during the year and paid all their clients too much interest on their investment, provide for the interest on the fixed deposit. And then we've got a note which is saying on 1 April 2021, the interest rate was increased from 12% to 15% per annum. You see now, there is an adjustment that is there. And the key point there that we have is that they paid too much interest. It means the figure that we are given there in the list of balance is a bigger figure. So we need to readjust it so that we get the actual figure, which is going to be a smaller according to this statement. So how can we find it? We go on to the explanation to see where the discrepancy is or the difference is. Then we go to the next sentence saying provide for the interest, provide for the interest on the fixed deposit. Then we have got the calculation of the interest in which it was supposed to be done on 1 April 2021. The interest rate was increased from 12% to 15% per annum. So we understand our financial year. Let's take note of our financial year. Our financial year is starting on 1 July. 1 July 2020. That's very important. We can take note this down as we start our question. And then it ends on 30 June 2021. That's the period. Remember, it's supposed to be 12 months, 1 year, as it is prepared on annual basis, right? And then we are told that on 1 April 2021, the interest was increased from 12% to 15%. So what does it mean? It means this interest was increased. So when it was 12%, you have to count the number of months that are there when it was 12%. So you'd see that since our month is starting on 1 July, let's say the months that are there when it was 12%. When it was 12%. So it was 12% up to 1 April 2021. So we have the whole of July, it was 12%. July, August, September, October, November, December, January, February, March. Then April, 1 April, it was increased. So April, not going to include it. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. So we've got 9 months, 9 months when it was 12%. So those are the months that we are going to use. And then we go when it was now 15%. So this one represents 12%. And then we see now when it was 15%, we also count, it was 50% from April. So we have the whole of April, May, and June. So it means it was 15% for 3 months. And we go again on the list of balances to see the amount of the fixed deposit that we have. Let's try to see what amount of fixed deposit we have there. So if you come up there, you'd see that the amount of fixed deposit that we have for the African Bank is 100,000. So we are going to use that figure to calculate the actual amount that was supposed to be for that period. So here, now we are saying it was 100,000, remember? So for the first period, when it was 12%, we are going to say 12% is a decimal, you know, it's 0.12. We multiply it by 100,000. When you do this, you get the interest for the whole year. But we are going to make a proportion in terms of the month when it was 12%, it's 9 months. So we are going to multiply by 9 over the total amount per year is 12 over 12. Then you get the proportion in terms of 9 months. So if you calculate it as it is, let's try to see. Let's try to make the calculation there. We are going to say 0.12, and then we multiply by 100,000. Then you multiply by 9 over 12. You are supposed to get 9,000. You are supposed to get 9,000 there. Let's have 9,000. And then we now calculate for the second period when it was 15%, we now say 0.15 times 100, 0.12 there, it's supposed to be 0.12 here, the percentage is 12%. So you're saying 0.12 times 100,000. And remember, it was 12% for 3 months, so we're going to say 3 over 12. So when you calculate that one, let's again try to calculate that one. We say 0.12 multiplied by 100,000, and then we multiply by 3 over 12. Right, you get 3,000. You get 3,000 there. So it means here you are supposed to get 3,000. Right. So it means the total that you have for interest on fixed deposit for the year, you're going to add 9,000 plus 3,000. Then you get what? This is the total now. Then you get 12,000. So this was the amount that it was supposed to be. It was supposed to be 12,000. It was supposed to be 12,000 there. So we go on to check. We go on to check the amount that we have in terms of Let's recalculate here. We've got 0.12, then we multiply by 100,000, then we multiply by 3 over. So I think the error that we made there was here. We are supposed to say times 15%. It was 15% for 3 months. So here it was supposed to be 0.15, sorry. And then we multiply by 100,000 times 3 over 12. So we can recalculate there to see the actual answer that we get there. We can recalculate that one. It says 0.15. Remember, it was 15% for the 3 months times 100,000. Then we now multiply by 3 over 12. Then we are going to get 3,750. So we are supposed to get 3,750 here. So now when you add 9,000 by 3,750 to get the total interest received for the year, you get 12,750 here. So that's the figure that we have for total for that year, this one. So we go back to check the interest that was actually received. And we are told that the interest that was received was more than what was supposed to be received, according to what the statement is saying here. The statement is saying it was too much, and we go to check the amount that was received that we have in the nominal section. So if you go to the nominal section is saying interest on fixed deposit 14,500. You see now it's bigger than the figure that we got there. So we go back and find the difference that we have there. 14,500. The figure that we have is 14,500. So we are going to say find the difference 14,500. This is the figure that was received instead of 12,750. Then when you calculate that one, you are supposed to get 1,000. You're supposed to get 1,750. We can just verify to see if that's a correct calculation. 14,500. You subtract 12,750. Then you get 1,750. So that's the figure that we have here. So the figure that was received for interest on fixed deposit was more with 1,750. So it means now this one does not belong to this period. It's a prepayment in terms of it's a prepayment that was received in terms of interest on fixed deposit. So remember, we adjust for those prepayments. We remove prepayments because they represent amounts that do not belong to this period. And we are going to consider them in the financial period in which they belong. With that, we are trying to abide by the matching concept or the accruals concept. So we are going to remove that one from 14,500 that we are given there in the question. Remember, we're also supposed to show it the 1,750 in the workings for interest on fixed deposit so that you get marks. So by the fact of you going to show that you are going to subtract 1,750, you are abiding by the matching concept. You're not supposed to put this actual figure, which is 12,750, straight away. You have to show the working in brackets on how you arrived at 12,750. So we go to the balance that we have. So this figure that we are given is more with 1,750. So we're going to subtract it. So we go to the answer section and just summarize that working. And then now we have here we're going to start with interest. Interest on fixed deposit. Interest on fixed deposit, which is going to be 14,500. Then we subtract the 1,750. So when you calculate that one, we are supposed to get 12,750. Then you also go to the next income that we have. Remember, I said the incomes that we have in the question, we're going to find them on the nominal section. So here, you see that if you go down, we are not seeing any income that we are seeing there in the right here. But now rent received is also an income that we have, which is 18,000. But before we put this 18,000, we go again to see what this 18,000 is all about. If you've got any adjustment, you make the adjustment. If there are no adjustment mentioned, we are going to put that 18,000 as it is in the statement of comprehensive income. Right, we go there to the additional information to check anything about rent. Go to number 3. We have got something that is explaining about rent, which is saying rent has been received up until 31 December 2020. There has been an increase of 10% implemented on 1 January 2021. So basically, the rent that was received is from July. Remember, that's where the year is starting, July up to December, and then we count how many months do we have there from July to December. We've got July, the whole of July, August, September, October, November, and then December. That's the rent that was received, and we count how many months: 1, 2, 3, 4, 5, 6. So we've got 6 months that we have that for the rent that was received. So the rent that we have in the nominal section is for 6 months. But remember, according to the matching concept, we need also to consider the other months, the other 6 months that are remaining. We are supposed to add them because we want the whole amount that belongs to that period. But again, we are told that the remaining months has got a 10% increase. So firstly, we are going to find the monthly rent that was supposed to be received for the first 6 months. Then we know that before it was this amount, and then the amount that we get, we multiply it by 1.1, which is 100% plus the 10% that has been increased to get to make it 1.1 as a decimal. Then we find the amount after the increase. Then we multiply by the 6 months that are remaining. Then we know that for each and every month they were receiving this amount with an increment. Then we add it. Remember, in accrual, we add. This is an accrual which is supposed to be added. So we go back there to check the amount, the actual amount that was received for rent. We are seeing that is 18,000. It's 18,000, and it's for 6 months. So if we're 6 into 18,000, we're going to get 3,000. So this is the amount that was received per month for the first 6 months before the increase. So after the increase, now we say 3,000 times. Remember, before the increase, it was 100%. Then we now have an increase of 10. So it's now equal to 110%. So it becomes 1.1. Then we multiply it by the 3,000. Multiply by 1.1. Then we get what? When you multiply 3,000 times 1.1, let's try to calculate that one. We are going to get 3,300. So it means after the increase, it was now 3,000 per month, 3,300 per month for the next 6 months that are not considered there. So to find the prepayment, now we say to find the prepayment. To find the accrual, the rent that has not been received yet. We now say 3,300. Remember, here we said we are getting 3,300 after the increment. So for the remaining 6 months, now we are saying 3,300. Then we multiply by 6. So if you do that, 3,300, you multiply by 6, you're going to get 19,800. So it means rent not yet received is 19,800, but it belongs to this period. So we are supposed to add it. Remember, in accrual, we add whether it's income, whether it's expense, we add, and we do the opposite to prepayment. Prepayment or paid in advance, we subtract. So we are going to add to the figure that we have for interest received in the list of balances, which is 18,000. We're going to say 18,000 plus 19,800. So we go back to the answer section. We go back to the answer section now, and we are saying rent. It's rent received. Summarize the last part of the working, which is we have 18,000 that was there in the nominal section. Then we add the one that was not yet received, which is 19,800. So when you calculate that one, you're supposed to get 37,800. So that's what we have on rent received. Then also we try to look at any other. So before you go anywhere in terms of other income, there are other income that you have to check that might not be listed under the nominal section. We have got other income that we have to consider after you've exhausted all the income that are there. Let's try to see if we've got any other income. Then we look at those income that we have to take note of, even though they are not listed there. We have got credit losses. We also have credit losses. We can also try to check if we have any other income that is there besides that one. So we can check for other, right? We are not going to include this under the calculation of allowance for credit losses, because this one is already they are already credit losses, or we can rather call them paid debts. Those are customers that we sold goods toward credit and that are no longer able to pay us due to many reasons. So we write them off. For example, the person has gone out of the country, the person has died, so we are writing that person off in terms of the amount that person is supposed to pay. So that those are the credit losses. We are not going to put them under the other income, but we have got the allowance for credit losses. Those are the ones that we have to take note of. So it means we don't have any income that are there. We only have expenses that are left there. So the allowance for credit losses, we have to take note of them as one of those income that I was saying. We have allowance for credit losses. Credit losses. So these allowances can result in an increase or a decrease. So what is going to happen is the allowance that we are going to calculate for this period, you compare it with the last year's allowance, and if there's an increase, it represents an expense, and we are going to put it under the expenses section. It's an expense. But if there's a decrease, it's now an income. You include it under other income. So basically now, we are going to check that we have got a balance that we are given for the previous year that will be given in the list of balances, and then we compare it with the one that we are going to calculate for this year, and you notice if there's an increase or a decrease. Then also you have to check in terms of profit or a loss on disposal. If we have disposed or sold a non-current asset or fixed asset, we need to check whether we made a profit or a loss. If it's a profit, you are going to include it under other income. If it's a loss, we are going to include it under the expense section. So here, if it's a profit, it's now an income. If it's a loss on disposal, it becomes an expense. So these are some of the we might have a scenario of income if we are here and if we are also here. So you have to check of those things won't be stated under the nominal section, but you have to check in additional information what they are saying about those two items so that you don't skip them. So already we have got an allowance that we are given there for credit losses. If you check in the question, the list of balance is there that we have. We have got an allowance that we are given here, allowance for credit losses, which is 1,250. So this figure, we are going to compare it with the figure that we are going to calculate for this period. And to calculate that amount for credit loss for this period, we are going to say the percentage that you are given for the allowance, then you multiply by the fee, by the net we can call it net trade receivable control, or the net debtors. This is how we are going to calculate it for this period. So the net, we are saying the figure that we are given in the list of balances minus any adjustment that might be needed to be done there. So if you go there, you would see that the figure for the trade receivables control that we are given is 13,900. We have got 13,900. So we are going to input that one as 18,900, and we want to see if we have got anything that is reducing that amount before we calculate it. And also you have to take note of the percentage of that allowance for credit loss, right? You are given the percentage here on item 5, saying adjust the allowance for credit losses to 5% of trade and other receivable. And then in bracket, they're saying round off to the nearest rand. It means if you are going to get an answer in decimals, round it off immediately to the nearest rand, so that you don't put commas in that statement of comprehensive income, right? 5% is the rate. Then we check for any adjustments that are going to affect that figure for trade receivables control, right? If you go to number 4, they're saying so all items that are listed here on adjustment section, they are items that are, some of them are items that are omitted in the when entries were made, it was omitted, so we need to enter them. For example, we've got number 4, it's saying L. Robertson, a debtor, was declared insolvent and this debt of 1,950 was written off. So this, when this is written off, it's going to reduce the amount of trade receivables. Remember, we said we are talking about credit losses. When it's written off, it becomes a credit loss. So it means this one is also going to increase the figure for credit loss. When we are now under the expenses, we are going to add it to the figure for credit loss that we are given there. So it means this one was not yet written off. It was omitted. So we need to remove it from the figure that we have for trade receivables to get the net figure. So if you go back here, now, we are going to say this one 13,900. 18,900. 18,900. Then we subtract the figure that we are given there is 1,950. And then the amount that you are going to get, remember the percentage was 5%, then you multiply by 0.05. 5% is a decimal, becomes 0.05. And we would see that when you calculate very correctly there, you are supposed to get, when you calculate it very correctly, you are supposed to get 597.50, and they are saying round up to the nearest rand, and the rand is here. When you check the figure behind the rand is 5. So when it's 5 in the range of 5 to 9, it's going to change this figure by +1. So if you make a +1 here, it will become 598. So this is the figure that we have for this period. And we check for the previous period, the balance for allowance for credit losses that we have. Remember, we have it there in the list of balances. So we are going to go up again to check the figure that we have for allowance. This we have it here. Allowance for credit losses. It's here. This one, it was 1,250 the previous year, and this year is this figure that we got, which is 598. So it reduced from 1,250 to 598. So this represents a what? A decrease. So this is the decrease that I was explaining here. When it's an allowance for credit loss, it's a decrease, it becomes income. So we are just going to find what amount of decrease do we have there, so that we include it under income. So to find that amount of decrease, we are just going to say 1,250 that we are given for last year minus the one that we calculated this year, 598. Right. When you calculate that one, you are supposed to get 652. So this is the income that we are supposed to include under other income. So we come back here. Right, we come back here now. Remember, we have got allowance for credit losses. Allowance for credit. Allowance for credit losses, and the figure that we have, allowance for credit losses. Remember, the last calculation that we made was 1,250. then we subtracted 598. So this is the calculation that you are just supposed to show in brackets, the last calculation. The pre-calculations, you cannot include them, but the last, that is going to lead you the final answer that you are going to put here. So if you subtract there, we say we got 652. So that's what we have in allowance for credit losses. So that marks the end of our other income that we have there. Then obviously we are supposed to add this other income that we entered there. And here also we close to show that these are the ones that we are adding to get the total of other income that we are going to put here. So if you add 12,750, you add 37,800, you add 652, you get 51,202. So this is the figure that is going to come here. 51,202. So we are adding other income, we add here to the figure for gross profit to get the figure that we are going to put here for gross income for the year. So again, we are going to add there. We are going to add there. So we are going to say 166,635 plus 51,202. And if you add those two figures there, you are supposed to get 217,837. So that's what we have there. So this figure now, we call it gross income. Gross income, we call it gross income for the year, or just gross income. Right, this is the figure that we are saying, gross income 217,837. Then from there now we go to the expenses section now. So basically here now we are just going to say, let's see here. Right, on the expenses section, remember we have the administrative, distribution, and other expenses. So here we are going to say let's take note of these indications of less that we are subtracting. Distribution, comma, we also have administrative, and also we have other expenses that are there, that we are, any other expenses that might be necessary to put there. And obviously we are going to list all these distribution, administration, and other expenses. We list them there, and then the total obviously it's going to go in line with that explanation of distribution and other expenses. So if you go down there, you would see that we are going to check the expenses that we have, and the expenses that we have are listed. They are listed there under the nominal section. So we are just going to go one by one to check the expenses that we have. We are just going to go one by one, and then we check the expenses. So here we are going to just list the expenses that we have here, and then after listing them, obviously the total of those expenses are going to come in line with the heading that we are having for distribution, administrative, and other expenses. It's going to come here, and we list the expenses in this column. So we go back there to our nominal section. That's where we're going to get our expenses. Go back to our nominal section. Right. If you come to our nominal section, you'll see that here we've got revenue. We are looking for expenses, revenue, not expense, purchases, not purchase returns, settlement, discount, interest on fees, deposits, rent receipts, income, carriage on sales. Right, carriage on sales. Remember, carriage on purchases is the one that we included in the trading account under the purchase figure. But when it's now carriage on sales, it becomes an expense. We're going to put it there under the expenses section, and it's a distribution cost, remember. So we are going to put it carriage on sales as 9,200. So we go there. We go to the under section. We have carriage on sales. We have carriage on sales. And the figure that we have is 9,200. So we're going to enter it this section. And then we go to the next that we have in the nominal section. So you see that under credit on sales, they've got credit losses. And remember, I said these are bad debts. These are the debtors that we wrote off as, and we said they are no longer going to pay back our money. So it's now paid. They've got 4,925. And also, if you go to the additional information, we've got something to do with those credit losses. We are being told that R. Robinson, a debtor, was declared insolvent. Insolvent means this person no longer has money, bankrupt, and his debt of 1,950 was written off. It means this person cannot be able to pay back our money, so we are writing this person of 1,950. And these figures that are under adjustments, we say they are omissions. It means so it wasn't included in the figure that we have for credit losses. So we are supposed to add it to the figure that we have there, get the total. So we go back there. 1,950 is the additional, and here we've got 4,925. So we're going to add 4,925 plus 1,000. Plus 1,950. So we go back again to the answer section, and we are going to when we come here now we are saying credit losses. So in brackets now we are saying the 4,925 that we are given in the list of balances, then we add the additional one in the additional information, that is 1,950. Then we are going to get 6,875. And we go back again to the list of balances to check for the next expense. We've got consumable stores. If this consumable stores is just listed in the nominal section, and we've got no adjustment information about consumable stores, we just take this one as an expense. But if you go to the additional information, we've got closing inventory of those consumables. So what it means, we bought consumables, and some of them we didn't use them. So we are not only concerned about those which we used. So from the consumables of 2,730 that we bought, we are left with 390. So the difference means is the one that we used, and it represents the expense. So we are going to say 2,730 to minus 390 to get the expense part. So go back there and input that one is consumables. Right. So on consumables, we are saying 2,730 is the one that we bought, and then we are left with 390. So the difference represents the expense. So if you calculate that one, you're supposed to get 2,340. Right. We go back again to check in terms of any other expense that we have under that. Right. Under consumables, we've got also insurance. We can also so the amount of insurance that was paid is 5,650. But we go to the additional information to check if we have any adjustment of insurance that we have there. So you'd see that. Let's check for insurance. Insurance, we have number 7 saying insurance has been paid up until 30 April 2021. Insurance has been paid up to 30 April 2021. Remember, the year is ending on 30 June. 30 June 2021, but it was paid up to 30 April 2021. So we want to count the months that it was paid. So it was paid from 1 July 2020 to 30 April 2021. In the how many months do we have there? We can count. We have it was paid from July, August, September, October, November, December, January, February, March, April. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it was paid for 10 months. So the figure that we have there in the nominal section is for 10 months. but we have other 2 months that are not yet included there. So according to the matching again, those 2 months belong to this period, so we have to include them. So you have to calculate what was the monthly payment, and then we multiply by 2 to get for 2 months, and then we add to the total that we have in the nominal section. So basically, let's go back there and try to find out in terms of the actual amount that was paid for insurance. We have a year 5,650. So what are we going to say? We're going to say 5,650 divided by the 10 months that represent this amount. And obviously, we're going to get 565. And then this one is the monthly payment for insurance. Then the months that were not paid for, or that were accrued, or that are still owing, are 2 months. So we multiply by 2 to get for 2 months. And when we multiply by 2, you are supposed to get 1,130. So this is the one that's still owing for insurance. So we need to add it to the amount that we are given in the nominal section of 5,650. So we go back. We go back again to the answer section and try to input that figure. So here we now have insurance. So for insurance, in brackets, we have the one that we are given on the nominal section, which is 5,650. Then we add the one that was owing, 1,130. Right. When we calculate that one, you're supposed to get 6,780. So that's what we have, right? We can move on to the next expense. Let's try to move on to the next space that we have there. Right. We can go and check again on the list of balances to check the next expense that we have. Right. If you come on the list of balances, we are on insurance. Then also have salaries. We also have salaries, and the figure that we are given for salaries is 96,250. Then we check on additional information if we have anything to do with salaries. So let's start from the beginning of the additional information. So here we go down to check if we've got anything that is to do with salaries. We are seeing that we are not seeing anything there. We go down. We are still checking for insurance, sorry, for salaries. See, there's nothing. So if you have such a scenario that we don't have any adjustment in terms of an expense, we are just going to check the figure that we are given there in the list of balances there as it is, and put it in the statement of comprehensive income. So it means we are going to, for salaries, we are just going to put 96,250. So we go back there. Go back there to the section that we have for let's try to go back there. Right. If you go back there, you'll see. Right. So for the figure for, if you come here now, the figure for salaries, we are just going to say salaries. And we put that figure that we have in the list of balances, that is 96,250. Right. We other salaries also, we go and check if you've got anything again after salaries. So you'd see that after salaries, we've got also water and electricity, which is 18,400. So we go and check again additional information if we've got anything to do with water and electricity. Water and electricity, let's start from the top. So here we go down. We check if we have got any adjustment to do with water and electricity. We see we have got nothing there. So if you have nothing, we are going to take again that figure that we are given there as it is, which is here we've got 18,400. So we are going to take this figure and put it there in the other section. Right. So here we have water and electricity. And the figure that we are given for water and electricity is 18,400. Right. Then we check if we have got any other expense that we are given. Any other expense. Right. You'd see that after water and electricity, we have carriage of purchases. We included this in the trading account. Import duty again included in the trading account. Then interest on loan, and we remember interest on loan is a finance cost. We adjust it after calculation. After we've calculated all the expenses, we're going to subtract all the expenses from the gross income. Then after that, that's when we are going to adjust for the interest on loan. So we cannot include it now, so we leave it. But then if you go to additional information, we've got an issue of depreciation. Depreciation is always on the additional information. And we go to number 6. Number 6, that's where we've got the issue of depreciation. So if you come here, number 6 here, that's where they are explaining about depreciation. Non-current assets must be depreciated as follows: equipment at 20% per annum according to the diminishing balance method. And then we've got the vehicles at 16% on cost price. So what is going to happen there is that we are going to calculate for equipment using diminishing balance method here. So let's start by equipment using the diminishing balance method. So here we can go there and try to calculate it there. Equipment is diminishing balance method. And the balances that we are given there are there on top in terms of these figures. So you'd find that the formula that we use for the diminishing balance, we say percentage times the carrying value to get the depreciation amount. Then the carrying value, we would just find it by saying cost minus accumulated depreciation. So that's what we are going to do here. So if you have to check if we have got any additions in the questions that were made in terms of these equipment. So you see that in the additional information, we don't have any equipment that was bought or sold. So we are just going to use the figures that we are given there, the balances that we have there. So if you come here, you see that the balance for equipment that we have for costs is 240. This is that we have for the costs. And then accumulated depreciation for equipment, we have got 48,000. We have got 48,000. So what is going to happen there is that we are just going to say 240 minus 48,000. Remember, costs minus accumulated depreciation get the carrying value. And then the answer that you get to multiply by the percentage that you are given, which is 20%. If you go to the additional information, the percentage is given there is 20%. This is the percentage that we are going to use for equipment. So here, the calculation, we are saying 240,000 minus 48,000. Then we get our carrying value. Then we multiply by 20%, which is 0.2 as a decimal. So when we calculate that one, you're supposed to get 38,000. Sorry, when you calculate that one, remember when you say 240 minus 48,000, you get 156,000. Then you multiply by 20%, and you get 38,400. So this is depreciation for equipment, but we want total depreciation including the depreciation for vehicles. And then we go back for vehicles now to check what they are saying about vehicles. Vehicles, they are saying 16% on cost. So this is basically on cost, but they've got a note there that's saying a second-hand vehicle with a gross carrying value of 67,500 was bought. So we bought a vehicle for 67,500. And this vehicle, if you come back here, it's already inside here because these balances are on 3rd June 2021. So this balance that we have for vehicles for the cost 460,250, there is that amount of the vehicle that was bought, but it came along the year. So we want to remove it from this figure that we have here so that we are left with the the vehicles that stayed in the business for the whole year. Then we calculate the depreciation for those vehicles that stayed in the business for the whole year. And that one that was bought, we calculate the depreciation on its own, and then we apportion in terms of the month that it stayed. So let's start by calculating the ones that were there for the whole year. We say 460, 250, and we remove that one that was bought, and we know that one that was bought was 67,500. Then we are left with when we do that, we are left with 392,750. And then we now say these are the vehicles that said for the whole year. So we're saying 392,750. Then we multiply by the percentage that you are given, which is 0.16. 16% is a decimal, becomes 0.16. Then you get 62,840. So this one represents depreciation for those vehicles that stayed for the whole year. Then you calculate for this one that was bought along the year. It was the depreciation is 0.16. Then you multiply by the cost of that vehicle that was bought along the year, and you go back to check how many months that did it stay in the business. If you come back here, you would see that this vehicle was bought on 1 January 2021. So it stayed January, February, March, April, May, June. The year end was on the end of June. So we have 1, 2, 3, 4, 5, 6. So it stayed 6 months. So we make a proportion of 6/12 in terms of the depreciation that we got there. Because when you say 0.16 times 67,500, you are going to get depreciation for the whole year, but it only stayed for 6 months. So you multiply year, by 6/12. So we are going to multiply by 6/12. So when you calculate that one, you are going to get 5,400. Right. So total depreciation for vehicles, now we are adding this one, those who stayed for the whole year plus this one that came along the year, to get the total for depreciation for vehicles. So when you add the 2 year, you are supposed to get 68,200, 68,240. 68,240. So that's what we have. So this is the depreciation for vehicles. And then for equipment, we find it here is 38,400. So total depreciation that we are going to put in the statement of comprehensive income, we're going to add this one plus this one. So basically, here we are going to add this one, and then we add with this one to get the total. So we can just go ahead and summarize that one for the sake of depreciation. So here now we say depreciation. Remember, we said is 68,240. Then we add 38,400. So when we add the two, you're supposed to get 106,640. Right. That's what we have in terms of depreciation. So this was the last expense that we had here. So we are going now to add all the total expenses that we had here. So remember, the total expenses are starting from carriage on sales down to the figure for depreciation that we've just calculated. And when you add all those expenses, you're supposed to get 246,485. 246,485. And remember, this figure is going to come here where we have this heading for these expenses. Remember, the heading is here. That's where we've got the heading. So that's where it's going to come. Remember, we are saying we got 246,485. So this is representing distribution administrative, Sorry, it's not supposed to come there. Sorry, it's a mistake there. It's just supposed to come here. That's where it's supposed to come is 246,485. So this one represents distribution, administrative, and other expenses. And obviously, we are saying less there, so we are going to subtract here. So when you now say this one, gross income minus this distribution, administrative, and other expenses, you now get the figure for the net profit that we have there. Right. Then here we can just leave it as it is and go down to the finance cost now. We now moving on to the next section, which is the finance cost. Remember, we also need to subtract the finance cost. So the finance cost is going to come now here. We are now just going to list it here as finance cost. Here we're not going to subtract and put the net figure here. We can just subtract the net the finance cost. Then after that, now that's when we are going to get the net profit or loss for the year. Then we are now going to say here finance costs. Finance costs. Right. So for the finance costs, now we can go to the question to try to see what interest, in terms of interest on loan, what do we have? So if you come here, I think we have got that information on additional information. We see they're saying the interest on loan is still due. A payment of 30,000 was made on 30 September 2020. A payment of 30,000. It means another loan was received on 30 September 2020. So let's just count the months before we received the loan and after. So if you go back, let's start by going back and check the amount that we have for loan. The amount that we have for loan there, we can check it there. Right, we have a loan from Trust Bank that we have 120,000. 120,000. And remember, the explanation is saying, let's go back to the explanation. The loan that we have is 120,000. Let's just put the figure there. It's 120,000. Right, the loan that we have is 120,000. We have a loan of 120,000, but this figure is at the end of the year. This figure is at the end of the year. But then we are told that this one was not a loan that was taken, but it was a what? A payment. It means this balance that we have is after the payment was made. Is after the payment was made. So it means that before this payment, we had a balance of 120,000 plus the 30,000 that was paid. So before we had 150,000. This was the balance that we had before the payment. Then after the payment, that's when now we had 120,000. So we need to know how many months were there before the payment was made. And we are told that the payment was made on 30 September and the year is starting on 1 July. So we are having July, August, and then September. So the before the payment, it was 3 months, and the loan was 150,000 for 3 months, and then the remaining months is 9 months. So it means for 9 months, for 3 months it was 150,000, the balance of the loan. Then for 9 months it was 120,000. So these are the balances of loan that we have for those periods. So, but now we want interest on loan. So the interest, we see it again in the list of balances is stated there. We are seeing that here, they are saying the interest is 18%. So we are going to say 18% of 150,000 before the payment. Then we multiply by 3/12 because it said for 3 months is 150,000. Then we also say 0.18 times now 120,000 when it was 120,000 after the payment. and then we make a proportion again of 9/12 because it was 120,000 for 9 months. So basically, that's the calculation that we are going to make there. So what we are going to do here, let's just make the calculation. So we are saying before payment, let's just say before payment, the calculation is 0.18 is 18% as a decimal. Then we multiply, it was 150,000 before payment. And it stayed for 3 months, 3/12. And then when we calculate that one, we are supposed to get 6,750. And then after payment, it's calculated as 0.18. It was now 120,000. And then we multiply by 9/12. And then you get what? 16,200. So it means the total now that we have for this interest is this one plus this one, 6,750 plus 16,200. So we go back to our list there and summarize that working. So here now, finance costs, we can just say in brackets 6,750 plus 16,200. And when we make that calculation, what are we supposed to get there? Let's check if these figures are the exact figures that we are supposed to get there. When we say 150,000, let's go back to our calculations to check if they are correct figures there. Right, if you come here, here's the calculation that we made in terms of before and after. Let's check in terms of the loan payments. Where are they? This calculation. If you say 0.18 times 150,000, let's try to recalculate to check if these figures are correct. 0.18, then multiply by 150,000. Then we multiply by 3/12. You get 6,750. 6,750. So if you add now 6,750, and then you add to the one that you got there, 16,200, you get 22,950. So this is the calculation that we have. So we're just rechecking if these figures were correct. And then there now, if you add the two, you're supposed to get 22,000. This is the finance cost, 22,950. 22,950. So this is what we have, and we subtract this one. Supposed to be subtracted, and remember, the column that we are looking for, that we want to get the net figure, we are going to put it here. So we put it here, 22,950, and then we subtract. Right. So that's what we have there. And then we make the calculation now. We make the calculation. Remember, we are now starting from top. We can go back to check the figures that we have there. We started from top there. We are starting from gross income for the year. So we are starting here 270,837. Subtract 246,485, and then the figure for finance costs, to subtract it again, 22,950. And then we are going to get the net profit for the year or the net loss for the year. So if you make that calculation, you are going to get a negative figure there. You are going to get a negative figure there of 51,598. So this one is a negative figure. And then this figure is a net loss for the year. Since it's negative, it's not net profit, but net loss. Net loss for the year. So that's what we have there in terms of net loss. And then if you have got other comprehensive income, we might have other comprehensive income according to the question. We are supposed to add them here, but in this question we don't have any. We are supposed to add other comprehensive income that we have for the year, but here we don't have anything, so we just and then the final figure that we get now becomes the total comprehensive income. Total comprehensive income for the year. And this remains the same figure, which is 51,598, because here we've got a zero here with nothing. So that is what we have in terms of the statement of comprehensive income. This is the final figure that we have. And then we also have the notes to the financial statements that we have there. It was note to the statement of financial positions at 32/2021. So we can just go there and try to the notes are now not very difficult, because we have already calculated all the figures in terms of depreciation. We've calculated. So we are just going to enter those figures that we are given from the list of balances. So to the on that note, we have it here. So we are just going to enter the figures as we are given in the question. So obviously, carrying value, here we have got carrying value. Carrying value, we are going to say costs minus accumulated depreciation to get carrying value at 1 July. That is where the year is starting, 2020. Then any additions, we enter it here. We only have one addition for vehicles, going to enter it. Then depreciation, we're just going to enter the total depreciation that we calculated for the period. And then carrying value is at the end. We also have cost here at the end, and then accumulated depreciation at the end. So let's just go through it, and then we list the balances that are supposed to enter there. So here, on additions at cost, so we are going to start here at cost at the beginning. These are the figures that you are given in the question. We can just go and check them there, and then we come and summarize them there, right? For vehicles, let's start with the vehicles. Vehicles is here. We have got we can start with equipment. Equipment, we've got 240,000. There was no equipment which was disposed or which was bought. So this one, 240, is going to apply as the opening balance of equipment, and also going to be the closing balance of equipment, because we didn't buy any equipment, we didn't sell any equipment. So and then the opening accumulated depreciation is going to be this one, 48,000. And then accumulated depreciation at the end, we are going to add this 48,000 plus the depreciation that we got for that year, which is 38,400. This one was the depreciation for equipment at the during the year, for the year, and then we add it to the one that we had at the beginning to get the accumulated depreciation. Then we subtract now the carrying value at the end of equipment. We are going to say 240 costs minus the total accumulated depreciation after adding this one to get the carrying value. So basically, we can just go and summarize that for equipment. So we are now on equipment here. We are saying costs, we had 240 at the beginning. It's stated there, it's given in the list of balances, and then depreciation that we are given in the list of balances as opening was 148,000. Then we subtract here to get the net book value. We close here. So when you say this one minus this one, you get now the carrying value. cost minus accumulated depreciation, get the carrying value. So you calculate that one, you're supposed to get 192,000. Right. Then for depreciation for the year is the one that you calculated, that you put in the income, in the statement of comprehensive income for equipment, and you remember the figure that we put for equipment was 38,400. So we are just going to put it here. We already calculated this figure, and then we go to the balances that we have at the end. Remember, there were no additions during the year, so we are just going to skip that one. There's nothing here, so we go at the end now. The cost is not changing because we didn't buy anything or sell, so the cost is not going to change. At the end also, we are going to have that 240. So what is going to change is the accumulated depreciation at the end now. This one, we are going to say this one that we have at the beginning, then we add the depreciation for the year to get the accumulated year. So if you add the two, you get 86,400. Then you subtract to get the carrying value at the end. 240,000 minus 86,400, then you get 153,600. Then let's go to land and buildings. Land and buildings, there's no depreciation, remember, and no additions in terms of purchase. So we are just going to input the figure that we have, which is 695,680, is going to go throughout with no depreciation. Remember, we don't depreciate these land and buildings. So here now for land and buildings costs, we are given it as 695,680. 695,680. 695,680. That's the cost. Depreciation, we don't have anything. So this one also is going to be our carrying value, 695,680. No additions, no. So the cost now at the end again remains the same, 695,680. And also this one we have nothing. So the carrying value at the end also remains the same, 695,680. Right. We go to vehicles now. For the vehicles, that's when we have got an addition that took place. But at the beginning, balances, we are just going to take what we have in the list of balances. If you come here for vehicles, remember we said this figure that we are given, 462,250, was including that 67,000, that figure for additions, which was for vehicles, which was 67,500. Remember, there was a vehicle that was purchased. So if you come here, that's where we got information of vehicle that was purchased. This one, which was 67,500. So to find the cost at the beginning, we are going to remove this 67,500. So basically, if you come here, we remove that one, the figure that we are given there in the list of balances of vehicles. This one is at the end, 460,250. Then we remove the 67,500. Then we get the cost at the beginning. So here, the costs at the beginning for vehicles. Remember, we are here, cost at the beginning. If you subtract that 67,250 from the balance of vehicles that's given there, you get 392,750. And the depreciation, you just take the figure that are given in the list of balances for vehicles. So if you come here, let's go back to check what the balances we have for vehicles. Accumulated depreciation on vehicles. Let's try to check. We have vehicles there, and then depreciation is 74,500 is the one that we have at the beginning. 74,500. That's the one that we are going to put there. So you have 74,500. Then you subtract here to get the carrying value. So this one minus this one to get the carrying value. Now we get 318,250. right? So that's what we have there. And then we have an addition which is going to come here. Remember, additions are, let's check there this side in terms of the row that we have for additions. Additions at cost, they are here. Additions at cost, so we're going to put the addition there. It was 67,500. 67,500. So here for depreciation for the year, we calculated it there in the statement of comprehensive income, remember, and it was 68,240. Then we come at the end now, we take the figure that we are given in the list of balances for vehicles. That's the one that we are going to put there at the end, which is 460,250. Then accumulated depreciation, we add the depreciation at the beginning plus depreciation for the year. 74,500 plus 60,240. Then we get accumulated depreciation here, which is 142,740. Right. Having done that now, you can now be able to add there, subtract there to get the carrying value. So here, when you subtract, you're going to get the carrying value. This one minus this one to get the carrying value. You get 317,510. Right. So that's what we have. So in terms of this note, nothing much, because as most of the figures we already calculated them. The task is on depreciation there, we've already calculated. Then we've got the total sections. Obviously, we are going to add, you're going to add what we have this side. If you add these figures, this one plus this one plus this one, you get the total, which is 1,205,930. Then here you add this one again, this one. Obviously, here you're going to put a line. This one plus this one plus this one. You get 328,430. The same applies here. We add this one plus this one. You get 122,500. Then if you subtract here, you say this one and this one, you're supposed to get this one. Then here we only have this one, 67,500 in that row. So I'm going to put it only. Then this one, we add this one plus this one. This represents the depreciation for the year. And you get 106,640. And then here we add this one plus this one plus this one. You're supposed to get 1,166,790. You come here again, you add the ones that are below. Right, you add here this one plus this one plus this one. Get the total here. You get 1,395,000. 1,395,930. Right. Then we add this one, you get 229,140. Then obviously, if you subtract here to get the, if you say this one and this one, you're supposed to get this one. So that's what we have in that note. Obviously, the next one we have got the inventory. Nothing much about the inventory. I'm just going to list the inventory that we have in question. The inventory is the next note that we have, note number 2. So on inventory, obviously we come to the additional information. That's where we have the information of inventory there. We just list what we are given. You come here. You come here, that's where I've got the information for inventory, information 1. Inventory for, you've got inventory 24,150, and then the consumable stores is 390. So you just add the 2, get the total for inventory. So remember, these figures that you are calculating are the figures that you are going to put in the statement of financial position or the balance sheet. So basically, there's nothing much there. So here now, we just say inventory. We put the figure for closing inventory, and the figure that we have is 24,150. 24,150. And then for consumable stores, For consumable stores, we have 390. Then obviously you add this one plus that one. Okay. Get the total, you put it here to represent the total for inventory, spend 4,540. Right. Then you go to the next note, see what we have in the next note. The next note is trade and other pay receivables, trade and other receivables. So this one is, we are going to start the figure for trade receivable control. Trade receivable control. So remember, the trade receivable control, there was that one that was written off, which we need to subtract to get the net one, trade receivable control. So we can check on the list of balance there to check what we have in terms of trade and receivable control. Right, trade receivable control, we are given it there on the list of balances. Right, if you come here, trade receivable control is here, you have 13,900. But remember, we have one that was written off there. Sorry, it's there on top. It's here now, it's saying Robinson data was declared insolvent and this date of 1,950 was written off. So we need to remove that one to get the net one. So we say the one that we are given here, 13,900 plus 1,000 minus 1,950 that was written off there. Then we put the net there. So here we are going to say in brackets, we have 13,900 minus 1,950. Then we get the net one, which is 11,950. Yeah, which we are going to put here, 11,950. 11,950. 11,950. And then after that, now we less allowance. Remember, for allowance for credit losses, there's the one that you calculated for the current year. Allowance for credit losses. The one that we calculated for the current period, we said it was 5%, and we said 0.05, and we multiplied this net figure to get the allowance for this year that we compared with for that one for last year. So when it says 0.05 times the net one, we got 598. We are supposed to subtract it to the whole figure here. And then we add any, remember, receivables include prepayments for expenses, and they include also accruals for income. So we come to the additional information. We have got an accrual for income that is there. For rent, we have got, there's been an increase of 10% on 1 January 2021. Rent has been received up to 31 December. Remember, we have got only rent for 6 months that were received. And then the other one that we calculated and we found 19,800 was not yet received. So that remainder is an accrual of an income. Remember, this is rent income. So an accrual of an income, we put it under the current assets, and in this sense, it's going to be under the trade and other receivables. Then when it's a prepayment of an income, if it was in a prepayment of rent, it was supposed to be under trade and other payables. It's now the opposite. So that's what we have. So when you calculated, we found 19,800 there. So that's the figure that we are going to put there for rent, 19,800. So we add accrued income. It's accrued income, and the accrued income that we have is rent income. And the rent income is 19,800. The 19,800. So this is going to represent the accrued income. If there were many, we're supposed to just list the accrued income there, then total we put here. Since we have one, it's going to be 19,800. And remember here, we are subtracting here. We are saying 11,950 minus 598. The answer we put it here. When you subtract there, we get 11,352. And you now add this one plus this one to get the total for trade and other receivables. We put it here, which is 31,152. So that's what we have on that note. Then we move on to the next note. Right. The next note is cash and cash equivalents. But basically, cash and cash equivalents, we look at the bank and petty cash if it's there, and also we also look at bank overdraft if it's there in the question. Cash and cash equivalents. We are just adding the closing balances of cash that we have, cash, bank, and if you've got an overdraft, we subtract. So here we've got, according to the calculation that I've given there, we have bank, we have petty cash. Only, that's only what we have, 10,600 and 100. So we are just going to list that to get the total figure for cash and cash equivalents. So here now we are saying we have got our bank. We have our bank, which is 20,600. 20,600. Maybe you can just put it here. 20,600, and then we have our petty cash. And our petty cash is 100. And then if you add the two to get the cash and cash equivalence figure, here you are supposed to get 20,700. That's what we have on note number 4. So nothing much on these notes. We are just listing the figures that we are given there. A little bit of calculation, especially on trade and other payables and trade on other receivables. That's where we have much of calculations in on the non-current assets there. So this one now is trade and other payables. So remember, the figure that we start with there is the figure for trade payables control. So we've got trade payables control. And these figures are given there as just balances. So if you come here on the list of balances, you can just come and check there. Trade payables control is here. It's 32,100. We're just going to end that one. And then we are going to also to add some accrued expenses that we have. We just take them from the question. We have got insurance that we prepaid, that we accrued, and interest on loan that we accrued. So here, if you come to additional information, we have insurance that we accrued. Insurance, remember there, they say the insurance has been paid up to 30 April. So the insurance for May and June was not paid. So it was an accrual of an expense. Remember, accrual and expense is under payables. And also, if it's income, it will be a prepayment of an income and payment in advance. It becomes a, if it's income, it becomes a payable. So here we have those 2 months that we calculated, and we found 1,130, if you still remember. So it's going to be also a payable. And then interest on loan also, we have also an accrual of interest on loan that we have. If you check in terms of, let's start by insurance, and then we come back to the interest on loan, the calculation of interest on loan. Right, on insurance, here we have insurance. So you can just say add accrued expense. If we have got a prepayment of a income, we list them below. So accrued expense, we've got insurance. And then the figure for insurance that we are given, we found it as 1,130. Then we try to find out in terms of what do we have other accruals of expenses that we have in the question. So figures for trade payables control that we are given in the list there in the balances. Remember, we are given traders control. Traders control, we are given it there is 32,100. So remember, 32,100 is the figure for trade creditors control or trade payables control, which is 32,100. So you put it here, it's 32,100. And then for the accrued expense, we have insurance that we have calculated there, that we have said is 1,130 according to our calculation that we did in the statement of comprehensive income. Then interest on loan, we said also there is an accrual. So if you come here, you would see that, remember I said the amounts that we are given in the nominal account section represents actual amounts received or paid. So what we received for interest payment is 10,650, but the actual amount that was for the period is the one that we subtracted in the statement of comprehensive income as finance costs, which is 22,000, which is 22,950. So you would see that 22,950 represents the amount for the period for interest or loan. But what was paid was only 10,650. So the remainder becomes an accrual of an expense. So what we are going to do there, we are going to add those two figures. Sorry, we are just going to find the difference between the two to find the figure for accrual. That's 10,650. We subtract it from 22,950. Then when we subtract these two, we are supposed to get 12,300. So this one becomes the accrual of interest on loan. So we are going to put that one as an accrual for interest on loan. So if you come back here on the other section, interest on loan, basically we can just summarize the working that we have there, which is 22,950. Then we subtract the figure that we are given in the list of balances. Let's recheck that figure. We have in the list of balances, we have 10,650. 10,650. So we subtract 10,650, and then when we subtract that figure, that's when we get 12,300. So here we have 12,300. So when you now add the two now to get the total for accrued expense, you get 13,430. So we put it here. So it's now indicating the accrued expense. So now we now have those figures, and then if you add the two now, we are now going to get the figure for trade and other payables, the total that we are going to put here. So we are going to say 32,100 plus 30,430. Then you get 45,000, 45,530. 45,530. So that's what we have there. And then on trade and other payables, then we go to the next note that we have in the question. So if you go down now, we have the next note, which is statement of changes in equity. Statement of changes in equity. So remember, when calculating these changes in equity, the formula that we use there, formula that we use for changes in equity, we say the opening balance of equity, then we add the profit for the year. If we have got a loss, we are going to subtract the loss for the year. And then we also less drawings to get the closing balance of equity that we have. So that's basically what we are going to do there. So what we are going to do, we are going to say, we say the opening balance that we have for equity, we add profit. If we have a profit, we add, but if we have a loss, we subtract. Yeah, depending on the, like in this case, we have got a loss, so we're going to subtract, and then also subtract drawings to get the closing balance of equity. So that's basically what we are going to summarize in terms of this working. This is the layout that you're going to put there in that statement of changes in equity. So if you come here now, we are going to start with the opening balance that we are given here. So here we can just say opening balance. So we have balance at at the beginning of the year. That is 1 July 2020. 1 July 2020, and the balance that you are given there, we go and check it in the list of balances. What balance do we have? If you come here, this is the nominal section. We go up there to find balance that we have. Balance that we have there. We have got the balance for capital is representing the open balance, which is 1,250,000. So that's the balance that we are going to start with. 1,250,000. So we start with that figure here. We have 1,250,000, and obviously now since we said we add net profit if there's a profit, but if there's a loss we subtract. So it means we are lessing here. We've got a loss according to the statement of comprehensive income that we prepared. Less total comprehensive, less total comprehensive loss for the year. And then the figure that we got for comprehensive income is the figure that we got there, which was 51,598. So you've got 51,598. Remember, that's the figure that we got for statement of comprehensive income. Then we also less drawings according to the formula that I gave there. We less drawings. Remember, that's the formula that I gave here. In terms of the calculation of the closing balance, here we've got opening balance. We add purchases. So we add profit if there's profit, or less loss if we have got a loss. Then we less also drawings here, and then we get our closing balance. So basically, that's what we are just trying to summarize there. So for drawings, you go back again to the list of balances to see what figure for drawings do we have. If you come here, you see that the figure for drawings that we have is 22,500. So you are going to come here. And say drawings 22,500. And remember, with these drawings, we are also saying less. So we subtract again to get the net figure there. This one is going to be our closing balance. So this one is balance at 30 June 2021. So if you say 1,250,000, you subtract 51,598, then you subtract 22,500. Here you get 1,175,902 as a positive. This is the figure that we are getting as a closing balance for equity or capital. So basically, that is what we have in terms of statement of changes equity, and that marks the end of our question. And as we see, our question is 77 marks. What a proportion of a paper! So it constitutes the bulk of the marks. So let's get used for the preparation of statement of comprehensive income, and then the notes to the statement of financial position, so that we don't make mistakes in the exam. Stay blessed. We'll meet again in the next video as we prepare for exams. With that, I am out.